Welcome, everyone. Thank you for joining us again as we have a discussion today with Horizon Investments. I'm so glad you could take some time to be with us and hear an update to our previous conversations. If you haven't listened to those conversations and you would like the link, please send me an email. I'll be glad to send that to you right away. Before we get started, I have a few housekeeping items I need to tend to. The first is in the upper right-hand corner of your screen. You'll notice that you can watch the video conference in either speaker mode or in panel mode. Panel mode will keep all of your speakers on the screen at the same time. Speaker mode will put the person who's asking a question or answering a question front and center on your screen. I do have a disclosure that I have to read today because we have a few analysts on the call with us, and we're very glad to do so. So just give me a moment while we get to the very important part of disclosures and compliance. So this webinar is created in April of 2020. It's provided by Horizon Investments and Tranquilli Financial Advisor for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. The material should not be considered financial advice or an offer to sell any product. Horizon reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that their assessment of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals, risk comfort level, and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. And of course, past performance is no guarantee of future results. So, disclosure out of the way. Let me introduce our panel that we'll have today. We're very glad to have Austin Fitch back with us. Austin is an analyst at Horizon Investments. He's been with the company since 2011. He's a certified financial analyst, the highest designation one can obtain in the financial field. Also, we are joined by Ron Saba, who is a certified financial analyst as well, part of the Horizon Investment team. He is a new addition to the conversation today. Ron has been with the firm since 2009. We're very glad to have him. He's got some very specific portions of market analysis that he does for us. And of course, Josh Bartholomew, who's been part of Horizon Investments since the early 2000s. Again, Josh and I have known each other for over 15 years, had a great working relationship, and I did not share it in our previous conversation. Horizon Investments proudly named one of Barron's 2019 Asset Managers of the Year. I'm very happy for them, happy for the trio that are on with us today and the entire team at Horizon Investments. They are very hardworking. They really do a great job, and I'm so glad that we can have them with us again today. I do have to ask you to stick around until the end because we will have a beard update. Okay, Josh, as you'll see in just a moment, has let me down, and he broke out the razor. And so we'll have an update on that. And I would like to mention that I'll have additional video conferences coming up. I will have Beacon Capital Management join us for a video conference, and outside the realm of investing and the work that I normally do, we're going to have a good conversation with a psychoanalyst coming up to talk about reintroducing all of ourselves out into the world. This has been a challenging time. I am so thankful for all of you and your work with me being so good about picking up the phone when I call or just reaching out yourselves. Please always know that I welcome your calls. You have the calendar link. You can schedule yourself anytime. So with all of that out of the way, let me bring it back to Josh Bartholomew. Josh, good morning, and please reintroduce the team for us.
Yeah, well, thanks, Lou. And I got to say right off the bat, if anyone can make a disclosure sound interesting, it's you. Great job there.
My best radio voice.
Yeah, it's so great to be back with all of you. Quite a bit's happened since our last call, so this serves as sort of an update. We've sort of framed or prepared, at least today, to talk about maybe 3 specific categories. We're going to cover the markets again like we did last time, but we're also going to talk specifically about earnings season and oil. two really hot topics right now. Earnings season being really kind of interesting because we have, as you mentioned, Ron Saba on with us, in addition to Austin, who many of you guys know. Ron's been managing individual equity strategies for 100 years or so, I think. And so his perspective, I think, is quite fascinating. You know, he is managing some specific portfolios, some dividend stock portfolios for Horizon Investments right now. One fun fact I can tell you is that Ron is one of very few money managers that have actually run 2 5-star mutual funds. So that's kind of an interesting fact about Ron. But we want to cover earnings specifically because he listens to a lot of really interesting calls with CFOs and CEOs. And this earnings season in particular is going to be quite interesting. So that's what we've prepared for you today. And I know, Lou, you've got probably tons of questions that have been sent in. So the floor is yours. We got the smart guys in the room. Let's run with it, and we'll try to keep it tight, but we're probably going to go a full hour. So stick with us, and appreciate all your all's interest.
Yes, thanks again, Josh. So I'll start with and we'll do it this way just so that we're not all talking at once. I'll ask Austin to start off on this one, and then Ron pick it up from there. If you would, Austin, give us a brief definition of what earnings season means, what it is and what it means, and then maybe we can ask Ron to add some additional color from there.
Yeah, absolutely, Lou. I think earnings season, and for those of you maybe that haven't heard the term, really refers to a specific portion of each quarter, and a quarter obviously being 3 months out of the year. But earnings season is typically during that first month of the quarter when corporations are reporting on their financial picture. So if you think about their top line sales, if you think about their bottom line earnings, those types of data figures they report on or announce kind of status updates in a sense for the previous 3 months, but then obviously oftentimes look even further back, maybe a trailing 12-month period to give investors and markets in general a much longer view. But then they also offer, and I think Ron will talk more about this on some of the specific examples, they also offer what they call forward guidance. And what that really means is they offer kind of a look into what they expect to see going forward. And I think we all obviously probably have a sense for maybe how earnings or sales have been hurt more recently. And I think what I would tell you, and I think Ron would probably corroborate this, that the forward guidance part of the earnings calls and the earnings reports this quarter are almost more interesting than the numbers themselves. And the reason I say that is because specifically in today's economy and environment, getting an understanding for where companies think things will be 3 months from now, 6 months from now, a year from now, is probably much more telling than for them to get on a conference call or a webinar and tell you that sales have come down or earnings have gotten worse because of the coronavirus. Again, I think we all understand that somewhat inherently. I think the more interesting part is what does it look like from this point going forward? And obviously that's what the market's trying to price in as well.
Ron, please add to that.
Please add to that. Yeah, I mean, to get into some specifics, so quarterly, think this. Most of the companies that we're talking about, their quarter ended on March 31st. Obviously, it takes them sometimes a week to compile the numbers, and then they come out and have conference calls and they talk about sales and earnings, as Austin said, and forward guidance. So the way I thought that you would maybe find it interesting is to say, you know, look, first of all, I have to say, when we talk business, it's not to dismiss any of the tragedy or any of that going on, but there are companies just based on what they do that are kind of there to help in a situation, the unusual situation we find ourselves in. And there's those that obviously get hurt. I think we could all probably talk about the ones that get hurt. You know, literally, I went through this morning, lots and lots of companies reporting earnings. Boeing, the big airplane maker, cutting production. General Electric does a variety of things, but one of the things they do is make jet engines. They're hurting. So in the category of companies that are hurting, General Motors the other day said it's canceling its dividend because that right now, in this period we're in now, don't have cash flow to cover the dividend. I think they're going to be fine longer term, but a company as large and important to our economy as General Motors is saying we can't pay our dividend right now. It goes on and on. Starbucks reported this morning and talked about how their global same-store sales are down 10%. Of course, lots of those stores are closed. So that's the negative side. The Starbucks, there you go.
No, Dunkin' Donuts is better, but that's okay.
Oh, okay, sorry. Yeah, the age-old discussion back and forth. But I just thought the flip side is kind of where the interesting, intriguing stories again in this kind of unusual place we find ourselves in the economy. But I just went through and found maybe some of the more intriguing stories. Hasbro. If you don't know Hasbro, they're the game company. I think they're the ones that you do Barbies and all kinds of things like that. Hasbro, 40% jump in sales of games last quarter. And then you think about it for a second and say, what are we all doing? We're sitting at home, whether we have small children, even some of us whose children are out. We will try to find a game to play. We're playing games we haven't played since we were young children in some cases. 3M is one of the very, very large, one of the largest industrial companies here in the U.S. 3M, inventor of things like sticky notes and Scotch tape. I think we know those things. People may not realize they're also the largest manufacturer of those N95 face masks that people are becoming really, really important, especially to the first responders and healthcare workers. They reported earnings. They've doubled their production globally of those. They make 100 million of those a month. Think about that. And at the time we're in, obviously there's a demand. And I've got more, the consumer staples companies, the Mondelez, the maker of Oreos, Clorox, obviously, Kraft Heinz that makes Kraft macaroni and cheese. All those are showing pretty dramatic increases. Netflix is, I'll just leave you with Netflix and say that's the one that.
Okay, I'm going to stop you there for a moment, Ron, just because I would like to, I'll say, park on earnings season. You hear so much about it on the news. It more or less comes and goes, and to a day-to-day investor, what does it really mean? So now, both you and Austin put a couple of things in there that I think we need to just unwind for a moment, which are the future view of what it means to a company. So everyone, and I mean everyone on this call, everyone that will receive the link, wants to know, what does it look like in the future? Of course, is it going up? Is it going down? That is of course the question I get the most, and I understand we're not going to answer that question specifically. I always answer that for all clients, that it'll go up or it'll go down. It's how we react to that that'll make us money or not. So the point of the question is this: earnings season looking forward. What does this earnings season look like right now? Austin, if you don't mind taking this one first. What does this earnings season look like right now, and what does that mean? What should that usually mean for everyone listening moving forward?
Yeah, no, and I think Ron hit on a good point and kind of given some of those examples. Is earnings season, at least that we're going through right now, has had pretty wild divergences in both directions. You've seen companies that are more economically sensitive come out with numbers specifically, but then that forward guidance that you're talking about, where you're looking out into the future, and there's so much uncertainty that things look pretty bleak in certain, for certain companies in certain areas. But then there are other parts of the economy, whether they are some of the companies specifically that Ron talked about, or if you think about, I would say maybe a little bit more generally, if you think about maybe some technology companies, if you think about healthcare companies, both of those have been, just from a sector standpoint, have offered pretty good forward guidance and offer good opportunity. So I would say you've definitely had this divergence that maybe is a little bit unique to the current environment that we're in. And I think it's important to understand that, because what you're really getting at is there's so much uncertainty in the market as a whole. But what I would tell you is there's more uncertainty in certain segments than there are in others. And I think that's really playing out in earnings season. Ron, what would you say around that uncertainty piece? I think the idea of uncertainty, and Lou, we talked about this on our last call, is something that is definitely prevalent, but there are firms that are much less uncertain than others. Is that a fair statement, Ron?
Yeah, absolutely. And here's what I would say. Here's the important thing. So if you're watching a Jim Cramer or a CNBC or the stuff, there's certain things they talk about. I can tell you, as somebody who's, makes a living picking stocks and doing analysis of stocks, there's only a small portion that most people hear about. There's very, very important portions. And the reason I'm saying it like this is, think of time.
Okay, Ron may have frozen there.
I was going to say, we may have lost Ron.
Let's say as it relates to the coronavirus and the shutdown. But, what is – no, I didn't. Can you hear me? Can you hear me?
I got you, Ron.
Okay, there.
Your hand gestures, Ron.
They're
the camera up.
There you go. I know, having fun. But think of the time element, though. Think of the time element. Like we can be pretty certain that tomorrow things are going to look kind of like they do today. I'm sitting in my home office. A week from now, a month from now, 6 months from now, a year from now, 3 years from now. So if you're looking at, let's use extreme cases. Let's use, airlines, for all intents and purposes, they're flying, but they're flying. Delta's number of flights was down 90% year over year. But then you can ask yourself, and you relate it, the reason I'm saying this is you relate it to Delta stock. I'm just using one example, Delta stock. Let's fast forward 3 years from now. What do you think 5 years from now? What do you think Delta is going to look like? I'm sure there are a variety of opinions of people on this call, but do you think people are going to be flying as they were prior to this shutdown 5 or 6 years from now? I don't know if it's going to be exactly the same, but my guess is there's going to be more people flying a number of years from now than now. So that's my point, is when you're doing that analysis, there's this tug of war between short-term, long-term, uncertainty, what happens, all of the scenarios. And so what you see in markets, and people talk about markets gyrating up and down, that's literally, you're watching it in real time, that tug of war of people trying to decide how things are gonna fall out. And a lot of people will say, well, why is the market up? I think, the market up is because, for now, people are probably saying there's been some kind of relief, that the news has been a little bit better in some cases, certainly in earnings reports, a little bit better than the dire consequences that people were anticipating. And so markets are anticipators. So markets will anticipate, hey, we're feeling a little bit better, so we're going to look out a little bit farther and anticipate that things perhaps are not going to be as dire as they are as I sit here at this moment in time right now.
Hey, Ron, so let me just follow up on that really quickly, though, because I think people might find it interesting as someone that's putting a portfolio together, actually doing that today for clients on behalf of advisors like Lou. There is an art to taking the information, like Austin was saying, and sort of making some determinations about the short-term or long-term future. In our case, we're probably in the middle somewhere, at least in terms of what we're trying to accomplish. But, give us some context historically. There's an art to what you're doing in normal times. There's really an art to what you're doing now. How accurate do you think you can be? Or are you just avoiding those companies like Austin talked about, where there's just such great uncertainty, even if they're good companies, are you avoiding them altogether? How do you put a portfolio together in this environment, and how does it sort of stack up historically?
Yeah, look, first and foremost, it's balance, right? You don't want to buy all of the companies that have got crushed because perhaps you think that things are going to get better a year from now. But you also maybe don't want to completely overload on the other side with things like cash or even just really, really, really conservative. A great portfolio has got a mix of all of that. But I would say one of the most important things, and just to continue that theme, is you hear about a company earnings or a company event. People don't talk a lot about timeframes, and people don't talk in the era we're in now much about valuations. And I'm considered a value investor. What a value investor means is not only do you look at company fundamentals and you have some sense for what time frame your investment horizon is, but you also look at what's the value of the firm, right? Stocks. I always like to use the analogy of a car, right? If someone pulled up a Ferrari in your driveway and wanted to sell it to you for $400,000, you'd be like, that's kind of expensive. If somebody pulled up and there was a little ding on the door and wanted to sell you a brand new Ferrari for $1,000, so brand new Ferrari for $1,000, most people on the call, I'm guessing, would say, wow, I'll go find $1,000 because I know there's a ding on the door, but it's probably worth a lot more than $1,000. You can take that same thing that we do every day in stores and car buying and apply it to the stock market. And so when you see these companies like the airlines that have bounced or some of the oil companies that have bounced, lots of people will say, oh my gosh, things are really bad. Why is it going up? The reason is because the valuations on some of these stocks that have gone down 70 and 80% got so compressed on the downside, and we're discounting such a horrible scenario occurring, and suddenly news comes out that perhaps maybe things are going to get better a little quicker than people thought. Those stocks are going to go up, not because things are great for them, but things have gotten a little bit better than the horrendous bankruptcy scenario that some people may have been playing in or valuing in on those stocks.
So it's a balance between long-term really good companies, but also opportunity.
Yeah, and markets like this will present investors with tremendous opportunities. Sometimes you just have to be patient, and on occasion you don't put your whole portfolio in, but you'll pepper your portfolio with some of these great opportunities that longer term are very likely to be really, really solid investments.
All right. So with that, if I can ask you to comment on the remainder of the year, is it possible to give us some sense of let's stick? I call it short term. The remainder of the year. I know two gentlemen who are on the call here as analysts. The next 7 months, we'll call it. That could seem like a lifetime for the two of you, but for me that's short term, and for clients that's short term. So, can you give us a short term perspective of earnings season, along with the compressed or compressed meaning down that valuation of stocks or cost of stocks? Can you give us some sense of what you're looking at for the remainder of 2020, which is a nice update from what we talked about last time? Go ahead, Austin.
Yeah, I would say, Lou, I think, and this goes to our conversation last time, given that uncertainty, I think what we're looking at is, when and how does that uncertainty translate into more quantifiable risk? Something that you can really start, and I think Ron kind of hinted at this, is starting to get a sense for when the bottom sets in. And what I would tell you in terms of an outlook as we head through the remainder of 2020, I mean, unfortunately, I think in kind of what you're referring to is kind of the short term, I think there's absolutely going to be kind of some choppiness in markets. And what I mean by that is, there are going to be up days, there are going to be up periods, like we've seen over the last 3 weeks, where to Ron's point, you've seen markets bounce back from the bottom that we experienced in mid-March, when market losses were 30, 35, in some cases 40%. You've seen those bounce back pretty strong. But I do think that there's absolutely the possibility for further downside or further loss between now and the end of the year. Again, from a market standpoint as a whole, I would tell you that the goal at Horizon is to use kind of that active management component to find segments of the market that either have opportunity, as Ron pointed out, or are on the margin are going to do better than maybe the market as a whole or other segments of the market. So I think you absolutely have additional downside risk. I would tell you the flip side of that, or the possibility, is that you get really some surprise, upside surprise is kind of how we would talk about it. But really what that means is good news that's not necessarily priced in or expected by the markets. And that specifically, and I know we touched on this last time, would be the idea of kind of a healthcare solution or a treatment or a vaccine. And I would tell you that right now, that's not necessarily priced into the market. I think the way that the market's looking at the remainder of the year is that this kind of pandemic that we're in has a pretty serious impact for the foreseeable future, even as Ron mentioned, even into 2021. I think you even saw it this morning with Gilead coming out with data on a treatment. And what I would tell you is, as you start to get more and more of that information that maybe isn't expected or isn't, the market doesn't see that today, as you start to get that actually starts to swing kind of that upside opportunity from the potential of kind of what the market's looking at looking towards in terms of the potential for maybe more bad news coming into the end of the year. Ron, what would you say?
Yeah, here's I've been doing this for almost 35 years, and you say, when someone asks me about the market, I start talking about a specific drug, and it seems like a bunch of silliness. But here's the reality. Austin mentioned it. There was some news out this morning for one of the primary, if you talk to healthcare folks, if there's any on the phone, you probably know this. There's a particular drug by a particular company called Gilead, which has been effective on different viruses in the past. They came out this morning and announced that the trials that they have been doing, so they give the medicine to sick people and then measure whether they get well or not. That trial came back and said this drug is effective. Now, there's still some more steps that need to be taken, but this drug is effective at treating people with coronavirus. So if we all sit back for one moment and say, there's a bunch of horrible things, we've been affected, all of us, and certainly family members and friends have been through things with this coronavirus. And if you say, on in the near future, there's a drug that you can give these people who are sick, and most of them will get better. They'll still have a rough time, but they'll get better. The entirety, not just of our human existence changes, but related back to the market. Suddenly you can open the economy up. Suddenly people can go to restaurants, they can buy cars, right? Everything that we've just talked about on the negative side begins to get somewhat better. Now, do I think that that's going to happen tomorrow or the next day? Look, we've all changed our way of thinking when we go outside of our homes, I think, in everything that we do. And there are going to be bumps. The market is going to be volatile up and down. But I think this particular treatment angle, and then a vaccine, which some very, very large companies and some very large government agencies are working really hard to get out before the end of the first quarter of next year. Some talking about the end of this year, but first quarter next year. If we get a treatment and a vaccine that are effective by this time next year, that whole timeline that we're talking about of people getting back on planes and going out and interacting with one another becomes a lot shorter. And so I believe, based on the number of scientific brainpower that is heading and trying to do this, they're going to succeed. It's just a matter of how long it's going to take. Now, that said, I will say, to your point, Austin, and to you, Lou, the markets are going, because of all of the things that are going on and the variability of GDP and the economies around the world and things, you're going to see some whooshes up and down, and you just kind of have to be prepared for that and understand that that's going to be part of this process of working through this whole coronavirus.
Excellent. Thank you, Ron. And I have to say, I love the visuals. Okay, the roller coaster. that is, and I'm serious. That's very helpful. And I do want to assure everyone, this is water, not rubbing alcohol I'm drinking right now. Okay, so so with that, with the market, with earnings season, we spent a good amount of time on that. It leads to the discussion of the market, and I appreciate both of you giving some thoughts about the remainder of the year, and I'd like to dig a little bit deeper into that. So we've had this earnings season, which as you mentioned, we've got ups, we've got some, we'll call them severe ups, and some severe downs. Not a whole lot in the middle. Am I right about
Yes.
taking that out of the conversation? There isn't a whole lot in the middle, so it is a bit of a roller coaster ride. So the market right now, we've had a really nice upswing in the market. Would you call this well, is it psychological? Josh brought up the VIX, and I want to stop there for a second. VIX, volatility index. For everyone, we didn't explain that on the last call. The volatility index, which is my second favorite index behind the Russell 2000, but the volatility index, I call it almost a psychological test of the markets. How much risk are people willing to take? So if anyone listening now or listening to the replay of it, when we send it out, wants to look up the VIX, VIX, just search for that, and it'll give you an idea. 0 being no concern, if you will, about the market. 100 being everyone is very, very concerned about the market performance. The VIX, Josh mentioned last time, had dropped to about 44 at that time, which was early in April of 2020, just for our friends in the compliance department. So with that out of the way, the question is this: markets are up. Why are they up right now in your analyst expectation? Ron, I'll let you take this one first.
Yeah, it's simply the the anticipation. So when they were down so much, it was anticipation that things were going to be really bad for a long time. We get the other side of that now. So Lou, you're right, because if we were all in a room and you would indulge me and we would go through annual reports and quarterly reports and spend hours and hours doing that, guess what? The stuff we're looking at now is really bad. And oh, by the way, all the companies that are coming out and telling you what they expect next quarter, most of them are saying it's going to be even worse the next time they report earnings 3 months from now. And so this is wholly, to your point, Lou, this is wholly psychological. Now, it's not to say that it's unwarranted, but it is psychological. It's people, again, people were looking really at where they were in a really bad sense several weeks ago when the market tanked. Now the entirety of the market is looking at it and saying, oh, if we look out into 2021, if we look out a little ways and we get some kind of treatment or things get a little bit better or the economies open up state by state, then I think that those earnings and those results are actually going to return, maybe not to normal, but they're going to get a lot better than they are now. And so I'll buy the stocks now. I'll bid those prices up now because I'm pretty sure the people who are bidding them up are saying, I'm pretty sure that that's going to happen 12 months from now. Things are going to be a lot better. So I'll buy that stock. Well, that's basically what's happening. So it is all psychological, Lou.
And Ron, I would maybe bring up a conversation that we had internally earlier this week and get your thoughts there. I think we made the comment that maybe the sell-off that we saw in markets in March was probably a little bit worse than it realistically should have been. And then the subsequent bounce back that we've seen over the last few weeks has probably been better than it should have been. We're probably realistically should be, if you think about what's the fair value of the market, it's probably somewhere in the middle today. Now, to your point, that changes as we go forward, but I think that's still how we're thinking about it. Is that a fair way to think about it?
Yeah, look, markets overshoot and undershoot forever and always. They always have and they always will, because ultimately, especially at the extremes, they're controlled by psychology. And so they will overshoot and undershoot. And that's a great point. On the bottom on March 17th, 18th, that was the panic. And I think maybe we've got a little bit of short-term euphoria, maybe a little too much right now, but which is not a bad thing if you own stocks, but a little bit of euphoria on the other side right now where you're overshooting a little bit about how good things are going to be in the near term, in the next 3 to 6, 7 months.
I mean, that's the reason why you believe that we could have some more selling or some more pressure, because we've maybe overcorrected too quickly based on psychology, not necessarily on fundamentals.
Exactly, because look, you hate to say it, but Lou talked about the next 7 months. Between now and the end of the year, there is going to be some bad news. If we polled everyone, I'm sure you could come up with, perhaps maybe in a certain state there are more cases than originally anticipated a month or two from now, or we opened up too soon in some place, right? There's going to, or earnings are not as good in a particular company for a whole variety of reasons in 3 months or 6 months. You're going to get those, and so when the market is going up based on, hey, I feel pretty good, and then I always say, I'm a fundamental guy. Earnings report are like the spotlight that for a moment shines on reality of that particular company or that particular sector. And when that reality hits and it doesn't look so good a few months from now, you're going to get a retest. That's okay. I mean, it's going to do this for a while, probably, and then hopefully as everything settles out and the economy kind of returns to some kind of normalcy, whenever you think that is, then I think we'll be okay.
Hey, Austin, just can I have a really quick follow-up on just from a perspective standpoint for all the folks on the call. Sometimes you hear this word institutional investor or big money. It's almost like there's these two types of people that act in the market. There's the everyday investor, like we have on the call here, a mom and dad that saved and put money into their retirement account, and probably may trade it, may not trade it. But who's driving the market? Who drove the market down, and who's driving it back up? And then what's healthy in terms of participants in the market?
Yeah, I think that's a great thing to highlight, Josh, is that difference between what you referred to as that institutional investor and that kind of more retail investor, where the retail investor is, the folks probably listening into this call. Institutional investors are going to be classified as, your pensions or your endowments, folks that have hundreds of millions, if not billions of dollars. And what I would tell you is oftentimes some of the bigger swings that you see from a market are driven by some of those larger institutional investors. And I think you saw some of that in the month of March, absolutely, in terms of you may have heard the term or seen in the headlines kind of this idea of selling pressure. And really all that means is that there's a lot of money, or there's a lot of big money investors that are being forced to liquidate securities in that case, which puts downward pressure on markets. What I would tell you is on the flip side, that can obviously be a boost as markets come back up. But I think to your question, at the end of the day, kind of a healthy blend really is just that. It's a blend between kind of those larger institutions, but also those retail folks. But there is confidence at the retail level, not just at the institutional level.
Great. And so let's get to that retail side, if you will, because I always equate institutional money. Just say Warren Buffett, Charlie Munger, institutional money. Okay, that's
Yep.
it. Warren's got $50 billion invested and another $50 billion in cash. That's not necessarily applicable to today's discussion that we're having. Okay,
Absolutely.
I'm happy for him, but we'll keep it right here. So I've had this discussion. I sent out a great piece from Horizon Investments showing the impact of a loss on a client portfolio, and I thank the clients that have done so, and hope more will do just this. They've sent out the previous videos. They've shared them with friends and family. I've had some of those friends and family contact me, talk about how they've invested. I'll use an arbitrary number, $1 million, and they indexed it. They were do-it-yourselfers, if you will, that indexed, and they fully participated in that 38%. I think Ron said it was March 17th was the actual bottom date so far. They fully participated in it. Now you're hearing the news, you're reading. I get the New York Times every day. You read in there market recovery. S&P is only down 13%. However, multiple conversations now have been, but I'm not only down 13%. Why am I not only down 13%? I took $1 million, went down to $620,000. I'm only supposed to be down 13%. Why am I not? and I have to then explain the math. But I'm going to take it out of my head and my mouth, if you will, and put it into yours, Austin, and say, please explain the power of losses. I'll say it one more time, but I'll do it 100 more times if necessary, because I think it's such an important concept to understand.
Yeah, no, I think, Lou, you're hitting on a really important topic when it comes just to the math associated with drawdowns, if you want to think of it that way, or losses within a portfolio. And what I would tell you is that in the example that you gave, if the clients had $1 million and then they viewed their statement when we were at the bottom and they saw it at $620,000, again, that's a 38% loss. Now, as nice as it would be to say they only need a 38% gain to get back to that $1 million, that would be really simplistic from a math standpoint, but unfortunately it doesn't work that way. And the reason being is because anytime you're viewing a percentage gain or loss, it's based on that starting amount. And a 38% loss on $1 million, yes, it gets you to $620,000. But a 38% gain when you're starting at $620,000 doesn't get you back up to the million. So 38% of $620,000 is probably roughly $230,000, $240,000. So if they gain 38%, for example, again, you lost 38, you gained 38, you would think that you're back in the same place that you started. Unfortunately, because you were coming off of a lower value as your starting point on the way back up, that gain actually nets you fewer dollars on the way back up. So I think that's important to understand. And maybe even a more simplistic example is to say that, let's say you got $100 and you lose 50%. So you went from 100 to 50. Well, to go from 50 back to 100, you actually have to double your money. That type of math, especially as you experience bigger losses in a portfolio, only gets bigger in terms of the gains needed to really recover from the losses that you experienced. So I think that's really important to understand, that it's not a one-for-one. Again, you may see the market go down, 38%. That means you actually need to go up even much more than 38% to get back to that starting value, if you will, from a portfolio standpoint.
Just about 64% on that example
Yep.
to get back to even. So, and I do want to follow that up with this, because it's I think it's fascinating. Actually, it's simplistic math that is fascinating. It doesn't matter if you've sold or not. That's the key. You could still hold the same number. So if we use that $1 and you had, let's say 100 shares, they all cost you 10 cents per share. Even though you held on to those 100 10-cent shares and they're down to 50 cents or $50, you still need a 100% gain on all 100 of those to get back to the original number, which again is I'll say it's simplistic math, but it's a bit confusing, because you would think, well, if I didn't sell it, then I still have the same underlying value. Not the case at all. So
right.
Thanks for taking a couple of minutes on that. Ron, if you would comment for us the changes that have been made within Horizon portfolios over the course of the last, we're now at April 29th. Let's take it all the way back, if you don't mind. Let's go 8 weeks. We've really started to see the bottom drop, I'll say the end of February. So if you wouldn't mind, give us an 8-week look at what's happening. And I know you can't go over every portfolio, and I think everyone would lull to sleep if we try to do all. So how about just we take a moderate portfolio? What does that look like over the last 8 weeks? If you don't
why don't I defer to Austin on that, because he probably do a much better job than I on that.
No, I can.
Austin?
Yeah, I can absolutely talk. So what I would tell you is, just generally within that moderate portfolio, over the last 8 weeks, you've seen a couple main themes play out. On the equity side, or the stock portion of the portfolio, you've seen an increase in what we call growth stocks and a decrease in value stocks. And really what that means is an increase in segments of the equity markets that are less sensitive to some of the economic issues that we've been experiencing, and less exposure to companies that are more sensitive to the slowdown that we've experienced. So that has helped from a volatility standpoint, and actually those types of companies, so less sensitive companies that we now own more of, companies like technology, companies like healthcare, have actually done well in terms of dampening volatility on the losses, but then also have recovered nicely on the gains. Those are companies like Amazon or Google on the healthcare side, Johnson & Johnson or many of these pharmaceutical companies that Ron was referencing earlier. So that's, I would say, within the individual sectors, if you will, and industries in the portfolio. I would also tell you within the stock portion that we've overweighted, we've increased our overweight to U.S. stocks and decreased exposure to specifically Europe. Well, I think what we would say is the U.S. is positioned to better really withstand the downturn, one, because we had a stronger economy coming in, but two, it is much easier to come out of a global pandemic because we are only one country, and obviously we've seen how much debate has gone on just within our single country around reopening the economy and what that looks like, as opposed to Europe, where the European Union, you've got 25, 30 countries where you've got to negotiate so many different, I would say, kind of incentive structures in a sense. So we think coming out of this that the U.S. is much better positioned than Europe from a regional standpoint. The other piece that I would tell you is on the fixed income or the bond side of the portfolio. Typically, obviously, that's going to be a segment of the portfolio used to dampen some of that volatility. And what I would tell you is we've improved the credit quality, or we've improved the quality of companies for which we're holding their bonds. And really all that means at the end of the day is that you continue to reduce that volatility associated with that portion of the portfolio. And why that's important is because should we have additional volatility or additional downside risk in the markets as a whole, that segment of the portfolio will really serve as kind of an uncorrelated position. And what that means is maybe when equities go down or stocks go down, you would hope that your bonds offer some sort of ballast to the portfolio as a whole. So we've increased and improved kind of the bond position such that it's prepared to provide that downside support should we need it if there's additional volatility.
Hey, Ron, let me just put 30-second follow-up, okay? I think this is so Austin gave us the perspective at the allocation level, but as a portfolio manager, to Lou's point, over the last, let's call it 8 weeks, have you been selling or have you been buying, and what are you doing now? Just very general, 30 seconds.
Yeah, I actually have been a net buyer. We talked about time frame and valuation. I've been a net buyer of some of the stocks, the ones that are a little more sensitive when they got oversold, accumulated some of those. And there's been some really phenomenal stocks that have been available when that panic selling occurred that generated opportunity for a stock picker. I would say real quick, Josh, Austin did a great job. Think of the growth. I think it's important to understand. Interesting to be overweight growth versus value. Think of growth. You want more growth stock exposure in your portfolio when growth in the economy is becoming more scarce, right? And there's no more scarce time than we're in now with the economy shut down and the coronavirus. It's really, really, really difficult to find companies that are going to continue to grow. And so the growth overweight on the portfolio is Austin said. Amazon, I think we're all maybe doing a little more shopping than we should at home online. Netflix is a growth stock. We're doing a lot of that. You kind of look at those types of companies, and the portfolio is skewed that way right now.
All right, and I promised as part of the email announcing this follow-up call that we would talk oil. So we've got just about 10 minutes to talk oil. And we saw something that everyone has talked about that I know of, which is negative oil prices. And there really is no other way for me to state it. I kept getting the question, I even asked the question, what does that even mean, a negative oil price? Now, the gas prices that we're seeing right now, I'm 53 years old. I've not seen since I was about 8, maybe 9 years old, which means Austin Fitch wasn't even born at the time. So he hasn't seen these oil prices. So what, and we're going to keep it just a couple of minutes each and bounce back and forth on a few of these. Either or, Ron, Austin, jump in. What happened with oil? What happened with oil, and was it politics?
Yeah, I would say this, Lou. So what happened with oil, and you mentioned going negative, I would tell you that it's a little bit technical, and we'll try to get far enough into the weeds to describe it, but not too far to lose everybody, is when you talk about the price of a barrel of oil, what that's being quoted as in the markets is what they call a futures contract. And really all that is you have a contract to, in essence, receive a barrel of oil when that contract expires. And in this case, it expired, the contract expired what would have been last week. So April, I think it was 23rd. And why that's important is because leading up to that, you had both supply side increases. So you had oversupply. You had both Russia and OPEC kind of butting heads and saying, we're going to just continue to pump and kind of open the floodgates. And then obviously you had demand side pressure, meaning that you have a global economic shutdown. People are buying and needing less oil, less gasoline, less energy as a whole. So oversupply, under demand leads to this idea of when that contract expires and folks actually, the delivery of that oil would occur. That's the price that's being quoted when you think about, what's a barrel of oil worth, right? And in this case, they're basically telling you, if we were to deliver that oil on April the 23rd, how much would you be paying for it? Well, because of the oversupply and the under demand that all came really to a point last week, you actually had a time when folks that were holding those contracts, in other words, they would have had to receive that oil, right? They would have owned the oil, if you will, once that contract expired. They didn't want it. They didn't need it. They couldn't take it. They didn't have a place to store it. So what they were in essence doing is they were saying, we will pay you, whoever it may be, the market, another buyer, we will pay you to take this off our hands. That's how you get oil prices negative. Normally you are paying to get a barrel of oil with that contract. Last week, what happened was owners of those contracts said, we can't take it. We have nowhere to put it. We don't need it. We can't use it. We need somebody else to take this off our hands. And they were going out and saying, please buy this from us. We will pay you to buy this oil. That's how you get oil prices negative. Now, you've seen oil prices since then go positive. That's because the next futures contract doesn't expire until middle of May. So in theory, the same thing could happen as we get closer to the middle of May. I think the hope would be that we have at least an idea of things starting to get back online. And you would expect maybe while oil prices would be low, they wouldn't be negative, because at that point, folks could actually take the delivery of those barrels of oil. But it's, I guess, always been a possibility. You've just never really had that confluence of events with oversupply, under demand, and then the expiration or that specific day of the delivery all falling right around the same period of time like it did last week.
Yeah, the perfect storm. Ron, I'll ask you to comment on whether it was political as part of it as well, because I've read multiple stories of presidents, emperors, rulers, whoever they may be, on the phone, effectively negotiating whether they would produce more oil or not. And will it continue to have a positive or negative impact on the economy? And I'll ask you to just spend about a minute on that, please. I know that's a little bit of a rush, but apologies.
No, that's all right.
If you could.
Yeah, no, here's what I would say, the political stuff. I think the geopolitical, so the Russia, Saudi Arabia, there's been a back and forth, well, there's been a back and forth there for years, but more recently there's been a back and forth there about who's going to cut production, and neither one wants to cut production. So there's the political part. I think the part about the people on the phone and all that, I understand that that's going on. I don't think that that's directly connected to this negative oil price. The negative oil price, I will dare say this, we will probably not see anything like that once this kind of all works through, because there was some, we talked about institutional investors, there's other investors, there's large hedge funds, there's other entities that own these futures that Austin was talking about. And not only did the storm happen in the market, but the storm happened in and gets really esoteric. Some of the people who've owned the front month contracts are changing their style, and they're big enough so they actually impact the prices of a commodity as big as oil. And so this is a little part of it too. They're changing the way that they're investing, and they're going farther out on those futures contracts. And so all of that mess that happened, and it happened again here in the last few days, but you're kind of just seeing this kind of like weird structural things happening. And so I'm not so sure the politics are probably a portion of it, but they're not the main part of it, I don't think.
Okay. Is Horizon Investments investing in oil right now? Because I've had more than one client call up and say, why do we not own oil? And again, risk has to meet the person I'm speaking with. Are you investing in oil, say exchange traded funds, mutual funds, futures contracts? Is that something going on at Horizon right now?
Yeah, Lou, I would tell you we're not currently invested or by any means overweight exposure to kind of the energy segment or sector of the market. I do think, and this is something that we've talked about internally, there may be opportunity there later this year. And the reason I say that is, and Ron, you can talk specific companies here in a second, but what I would tell you is that there's still so much uncertainty about what the path out of kind of this pandemic looks like, that to put an energy or an oil position into more of a core portfolio really adds an unnecessary amount of risk at this point. It actually adds uncertainty right now, which is kind of unquantifiable risk. Again, I think as we get further out towards the end of the year and you start to see what this path out of kind of the recession looks like, I think that may be an opportunity for oil as a sector. Ron, I think there's probably individual companies that maybe make a little bit more sense, but as a sector, I would say obviously we're staying away from it right now. Is that a fair way to think about it?
Yeah, think about it like this, right? So in the environment we're in, if you say, hey, well, let's look at an energy company, first of all, you're layering risk over risk over risk over risk over risk, right? We've got economic risk. It's going to affect almost every company. We talked about that. Then you have this oil shock that's somewhat impacted by the economy, but there's a lot of other stuff that we just talked about that are influencing that. You have earnings, you have all kinds of risks. Now that said, if you're going to own some, and I own some, one of the things I do at Horizon is run a portfolio of dividend stocks. I own very few, but the specifics of those are very, very low debt, very high cash flow, very highly hedged out. In other words, they know what they've already sold forward lots of their oil. So there's ways, my point is there's ways to approach, if you want, on a stock by stock, again, I'm not talking allocation portfolio, I'm talking stock by stock. There are stock by stock opportunities, but I would say you have to be very, 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 very careful in this environment.
Well,
yeah.
Leave that right there. That's an excellent way to leave that. Okay. Now, we're right up against the hour, and I appreciate all of you and appreciate everyone listening. And again, those that'll listen moving forward. We had some questions that I will let those that emailed them to me. We didn't get to those during this conversation. I will ask those of you offline and get to each of the clients who sent me those questions. I want to say thank you. Anecdotally, I will say that while I love pulling up to the pump and seeing $1.79 to put gas in the car, my office is 1 mile away from my house. So unless I go out onto which Route 78, close to me, is a major highway. Unless I go out on Route 78 for a long drive, I'm not using any gas. So I don't know that we'll all get to take full advantage of this. I'll knock on wood and say maybe we do. Anyway, I want to thank all of you. Again, offer to everyone listening now and in the future. There will be additional video conferences coming up. Can't say thanks enough to Austin, to Ron, and of course to Josh for arranging this, and everyone for listening. I will speak to you soon. Again, the offer is always there. Please reach out, and if there's any last words that you'd like to put in, Josh, I know you've always got something to offer, so please feel free to add anything in that you'd like.
Well, as I listen to these guys talk, Lou, I think that the real important thing, and I think this is why you work as a planner, which is so critically important right now for people to actually have a plan and work with a planner. What I would just say is the reason you're working with firms like ours and others is because it's very difficult to manage the difference between risk and uncertainty. They've used those phrases a lot today, where it's okay to have some risk. You got to take some risk to get some reward. But uncertainty is something like some of these oil companies that Ron just talked about. It seems like a good idea, but it probably isn't. And that job needs to be in the hands of people that do it for a living. It's not something we can speculate in. And that has to do with, that's oil, stocks, bonds, et cetera. I think the theme here is we're working hard every single day to find stability in opportunity. That's what we're doing. I think that's the theme.
Outstanding. All right. Thank you all again.
Thanks, Lou. Have a great day.
Thanks, Lou. Thanks, guys.
Thanks, Lou. See you guys.